everyone. Thanks for joining us after lunch. I hope you had a nice time mingling. So we will now be continuing with the session on converging sustainability regulation, developments in reporting, building transparency, and managing climate risk. I'm Taylor Pierce, senior economist at OMFIF, and it's a pleasure for me to introduce my esteemed panel of speakers today. We have Sasha Sedan, Director of ESG at the Financial Conduct Authority, Lee White, Executive Director of the International Financial Reporting Standards Foundation, or IFRS. We have Marcus Ingholt, Senior Lead Climate Economist at the Danish Central Bank, as well as co-chair of the subgroup on disclosures of the NGFS, and Carlo Funk, Head ESG Strategist of EMEA at State Street Global Advisors. So I'd just like to jump into the questions. Climate-related activities within finance, as we've discussed today, fall somewhere along the spectrum of aligning investment activity with climate goals or managing climate-related risks. So where do disclosures fall along this spectrum? I guess I'll start with Sasha.
Nice to have a microphone back in the real world, a bit like karaoke here, isn't it? So here we go. Disclosures. Well, disclosures aren't everything, of course not. It's about doing things and impact and everything else, but disclosures are very important, and I'm glad I'm going first because I'm sure not many people can say it doesn't matter about disclosure. So let's give some examples probably. If you're thinking about anything that's going on in the world at the moment, people are trying to price it. And if you're trying to price something, you need to know what kind of risks there are. And I think risk is the big one that I always talk about. And some of the times, and we'll go into this, people say things like, oh, but you know, I care about a lot of other things. You're like, well, what's material to the actual company? So let's talk about corporates, not just equities, bonds, real assets, infrastructure, anything. It's about materiality. And therefore, you need to have disclosures on that. Everyone's different, though. So it's a very important point that we don't just try and make one size fits all. Very different sectors out there in different locations and everywhere else. So I think that's really important. Secondly, it's not all about climate. I think that's a really important point. These things are becoming very high up the agenda. Wherever we are, and we do our own financial lives survey, huge survey, and the consumers want their money. They want their money to do well. They certainly, number one priority is to make a return, but they also would like their money to be linked to some of the things that they care about, or social factors. And so therefore this is becoming bigger, but this is coming from employees as well. So it's not just coming from regulators or other people. So disclosures are extremely important, but they're not all. There's going to be other things we'll talk about later that are just as important as disclosures. But of course, any company should be reporting what's important to its investors.
Great, thanks. Lee, do you want to follow up on that?
Good afternoon. Thank you, Taylor, and thank you to SPI for the invitation to be on this panel. The question, I think, if I repeat it correctly, was where does the disclosure fit along that spectrum? And I'd say at all parts of the spectrum. In the spirit of what Sasha was just saying, I'll be very clear. You know, I think the further you can get in precision in disclosures, the better that the capital markets can allocate the capital correctly. Investors are as well informed in what they need to know to take their decisions, and ultimately that will then lead to impact through those decisions as well. So I'm going to keep my first response fairly brief to say disclosure is very good and can have multiple impacts in how they're used.
Great, thank you. Marcus, do you want to comment? And then I'll come to Carlo on the investor side.
Yeah, so I mean, so essentially I just want to echo what has been said before. I think one point is that when you begin to price these risks, then you are actually also supporting the green transition, because suddenly there'll be an incentive for business models or for managers in businesses to transition. So even though disclosures to begin with are at the superficial level is about managing risks, then you could say that so you could say adaptation to climate-related risks would mitigate climate change.
Great, thanks. And Carlo?
Yeah, I mean, excuse me. Well, I mean, obviously, when you have the goal to directly finance the transition, like disclosure per se will not drive capital flows in a first derivative instance. That's clear. But when you then think about the value chain of how investors are making decisions and based on what kind of information they're actually employing capital, they rely on some form of data. The data they either research themselves, the data they are purchasing from third-party vendors in the market, and without accurate disclosure, not only accurate disclosure, but also disclosure that is focusing on the material and the important parts, the water, with all the best intentions, is going to be so muddy that investors have a hard time, or might have a hard time, to actually make capital allocation decisions based on this information. So actually, the disclosure piece is so absolutely paramount in the context of this entire ecosystem on how investors are making investment decisions. And then you can always like start to drill down what kind of metrics are important. We might come to that later, but again, when you think about the ecosystem of financial market decision making, it starts with disclosure the same way as equity analysts, when they put out a stock price target, they rely on quarterly earnings report, they dial into the quarterly earnings calls, and they try to find as much information possible in that regard to make informed decisions. And if you, even though you might have the feeling that something is in the cooking when it comes to climate risks and opportunities, without the disclosure, you can maybe as an investor shy away from acting if you are feeling insecure about what kind of information you can base this decision on, especially in the context of fiduciary money management, where pretty much every single decision you make, you need to justify. So absolutely, disclosure is at the very heart of this.
Great. Yes.
I was just going to say, we've just got to distinguish this, because we've all been there. You know, when you've had companies say to you, whether it's on anything, they say, the employees are most important asset. Words are very nice, but like, well, how much do you pay them? Do you train them? What's their retention? What's their churn rate? Any of these things. So you need proper data disclosure, and you need it sometimes to be assured to get trust, which is the next stage.
Great, thanks. So it sounds like it was a bit of a trick question, because the answer to where do they fall along the spectrum is across the whole thing. Great, I'd like to come to materiality now. So materiality is a key accounting concept in which financial information on a company or entity is considered material and should therefore be disclosed if a reasonable person would consider it important. That's the SEC definition. My question for you all is it now widely accepted that climate-related factors are being considered material? And specifically for Lee, which kinds of risks are considered, and how does this connectivity work with accounting standards? So I'll start with you, Lee.
Thank you very much. So to your first question, I just would have to say, yes, it is widely accepted. You know, I think there's a recognition that, and you didn't say it this way, Taylor, but I'd bring it out a little bit further. And the materiality focus with climate is both on the risks to an organisation and the opportunities. So it's both elements. And the standard that's been prepared by the International Sustainability Standards Board, which hopefully will be published by the middle of this year, will known as S2, very much focus on the risks and opportunities that need to be disclosed regarding climate. On the second piece, this is a really quite an important area, because the demand that came towards the trustees of the IFRS Foundation leading up to the announcements at COP26 to form the ISSB was very much, one element was very much coming through of, we want this to be in the IFRS Foundation because we want to see this connectivity with financial reporting. And so that is starting to really be moved ahead. I would say that we've seen already that the types of concepts being used on the accounting side, many of the concepts, not all, and the terminology is also being used in the Sustainability Standards Board. So you have that level of connection already, because the terms and the nature of the standards have the common language. What we do know as well, and I think this is actually happening today at the Accounting Standards Board, their meeting, and it's all on the public record, is that they will be looking at how they wish to advance further the recognition of the impact of climate back into financial statements. So the requirements are already there, but I think there more could be done in order to allow the guidance and the connectivity happening between the disclosures of this proposed S2 on climate, and then ultimately back into the financial statements as well.
Great, thanks. And we'll come back to some of the other work that the IFRS is doing in tandem with other initiatives and organizations. Sasha, did you want to comment on this?
Well, I think, I mean, the obvious answer is, when you're looking at any of these things, what you don't want is a 1,000-page document with every little risk that could possibly ever happen, because no one would then take anything seriously. So the obvious point is, tell me the 10 or the biggest things that matter to your company, and tell me the information that I need to make that. And otherwise you just get blanket pieces of paper that tell you that there is a possibility that this could happen or that could happen, and it just loses its emphasis. So it's pretty obvious, but then what's important is that it's done from a very strong governance process, that the audit committee or someone else says, these are the biggest risks that we've got. And I do think that's a really important point that Lee made. Opportunities. There's going to be a huge, and we're in the civil engineering building, there's going to be trillions of dollars spent in mitigation, adaptation, and things that are going to happen in the next 30 years. What are your opportunities as well that you're going to spend your money on? And so let's not always think about this as just risk and negatives. I think it can be very positive as well.
Great, thanks for that. Marcus, how is the Danish Central Bank thinking about these risks and opportunities?
Well, actually, I'll come back to that, but I would like to start somewhere else, and that's on this question about the extent of disclosures. So first of all, I entirely agree that we should focus on materiality. Just disclose material risk, because if the disclosures are too long, then nobody will read them, companies won't take care when doing them, and then they'll be useless. Secondly, there's this issue, especially in Europe, where we're discussing whether disclosures should have a single materiality, so just focusing on the risks to the firms, and perhaps also opportunities, or if they should be double materiality, or we should have double materiality, so focusing both on the risks and opportunities to the company, but also the impact of the company on the climate. And I mean, so as a central banker, our interest that lies with a single materiality, because this is about handling risks. Then I would say it's okay for politicians and other people to want the double materiality, but then they should call it double material. They should be clear that this is not just about risks, but it's also about assessing the impact of the company on society, and that's perfectly fine if you have it, depending on your idea about the role of a company in society. But it's not about risk management, and I think that's important to keep in mind. But it may be important for consumer protection or aligning investment activities.
Great, thanks. Yeah, that was also a point that was brought up in the last session on nature-related financial disclosures. Carlo, did you want to comment on?
Yeah, sure. I mean, first of all, short answer to the question if climate-related risks are being perceived as real risks and opportunities. I would say the vast majority of investment professionals, the answer is a very clear yes. Of course, depending on where you look in the world, there might be disagreements on a personal level, but when it comes to real investment professionals, by and large, the answer is an absolute yes. End of story. And actually, the interesting part there is we all discuss this under the umbrella of sustainability or umbrella terms like ESG or whatever it is. But I mean, at the end of the day, when you look at the at the TCFD, and you start to look at what the transition risk would mean, what a physical risk would mean, and you talk to an insurance company. I mean, no insurance company, like, of course, if you insure a building, the shoreline will define the premium or has an effect on the insurance premium, right? That has nothing to do actually with a lot of sustainability or ESG thinking. It's just like common sense, right? So in that regard, it's an absolute clear yes that this is clearly recognized from financial market participants and practitioners. Another comment of what Sasha made, and when we talked about materiality, it is not only, so first of all, who wants to read through a 100-page document, especially from a consumer protection perspective? Like, absolutely not. So this is why you have to define the KPIs, that's clear, but not only you need to do this because to narrow down actually the focus also of what can be digestible, but also that closes the door for companies to disclose things, maybe few things that are easily digestible, that are actually in fact irrelevant, right? That's also an important point, because often when people think and talk about KPIs and narrowing down materiality, it's clearly correct to say, well, where should I focus my attention? We all need to focus attention and have trade-offs, clear, but it also again closes the door to focus on things that are actually irrelevant. And companies at times can be quite smart to create narratives that seem to be very relevant for their operations, but in fact, they're not so much, right? So this is something, that's why this is so absolutely crucial.
So it's not just about having more information, but also the right kind of information.
And this is, again, not only in the context of climate, right? That is in the context of social and other governance elements, clearly as well.
Which we will come to shortly.
May I say one thing?
Yes.
Because I also think there's something, there's a lot of discussion over different technicalities about whether, one metric or the other metric, and some data. And all of that is important. Perhaps I'm talking it a bit too much down now. But what's even more important, that's good governance and good strategies. So, making sure that this basic housekeeping is in order. And that's really where it begins. And you can have the best possible carbon metrics and whatnot, but if there's a crappy culture within management, then it's not going to matter.
And Carlo, you mentioned about irrelevant things. I've been in rooms with companies that have told me that they've got dolphin-friendly soap, because that was what they wanted to talk about, which was, I'm very pleased for them. But it's, materiality, I was thinking, interesting, but, they just want to fill that void.
Yeah, good point. Thank you. By the way, if there are any audience questions that come up, please do feel free to raise your hand. I'll open it up at the end, but please feel free to ask as we go along. My next question is for Sasha. So there's been a proliferation of regulations on reporting and disclosures on climate-related factors. As the UK's financial regulator, what has been your experience with this? Is it preferable to kind of forge ahead with national standards and then think about harmonizing those with other jurisdictions? Or is it better to reach consensus first at a more global level?
Well, the quick answer is national standards won't work on their own. So there's easy. So we were one of the first countries to mandate TCFD. And just to give you some stats, let's use some real numbers. 64% of the companies in the premium listed in the UK said that climate was a principal risk. So they're already saying that. That's coming from the corporates themselves. And I would guess that's going to go upwards, not downwards, but that's up to them, not me. So therefore it's already happening. But we're using international standards. I'm working very hard. I'm the now vice chair of the IOSCO Sustainable Task Force to make sure that we have international standards for all securities regulators. Why? Not just because it's the right thing to do, because most companies and most investors are international. And that's the most important feedback we get all the time. Can we just have one set of metrics? Can we just have that? It is difficult, and there is going to be different debates coming on, but absolutely that is the aim, to get one kind of measures that we can use in different parts of the world so that anyone can compare, contrast, and trust, which is the thing that we talked about at the beginning with disclosures. It's not easy, but it is happening. Now, just meaning having one set of standards doesn't mean we all go at the same pace. So that's probably the more nuance of the question. And I always think about that. We went first on TCFD, or one of the first, but everyone else is doing the same thing. And some are doing it voluntary, some are doing it at large companies. We did it large companies first, large asset managers, and then we moved that on. So scaling and phasing is just as important, but moving in on the same road at different paces is really important. And I know that's something that we, as hopefully a progressive regulator, is trying to help bring that standards together. Same with ESG ratings, transition plans. We're trying to use international language and using the things such as ISSB to do that. So it's important, but of course people go at different paces, but it's exactly important for investors not to have 15 different metrics on the same thing.
Great, and just as a follow-up question, you mentioned the TCFD, Task Force for Climate-Related Financial Disclosures. Don't want to throw in too many acronyms without spelling them out, but where else have we seen convergence in standards, and where has there been divergence in regulation? Maybe not just in pace, but also in substance. Maybe Lee, if I could open it up for you.
Thank you. So let's try and set a little bit of context. So the announcements that were made at COP26 with the creation of the ISSB also that day announced that there would be a level of consolidation, because you've heard already in some of this dialogue that there's multiple, at that time there were multiple different sets of directions, requirements, and what we were wanting to make sure that we weren't just going to add what was then known as the alphabet soup of acronyms. An important part there was consolidation of two organisations, the Value Reporting Foundation and the Climate Disclosure Standards Board. Both of those were successfully done in 2022. And TCFD was really fundamental here because, you know, in a short period of time, they created a very significant amount of momentum, and we wanted to build upon that momentum. And so we used the TCFD as the architecture framework for the two standards that are coming up, both S1 and S2. So if you're an organisation or a jurisdiction for that matter that's actually already taken steps with TCFD, that can be the foundation point to then build to use of the ISSB standards. And so we've worked with the TCFD leadership and secretariat, and we think there will be a natural point of passing over from TCFD to the ISSB, but that remains to be determined exactly the timing of that.
Sure, and can you also speak about how the IFRS via the ISSB is working together with the GRI on standard setting?
I can, Taylor. So, and again, we heard some of this just being discussed by the panellists. So we have an MOU in place with the GRI, and I want to be really clear, this is not an MOU which is a piece of paper, this is in real substance. The two boards are starting to work through their program of priorities and to see where those priorities will cross over and where they need to work. We very much have a focus on what we describe as the two pillars of reporting. The ISSB purely on the investor focus, delivering what we need to do into the hands of investors. For the GRI, they have a multi-stakeholder focus. Marcus was drawing out this distinction earlier, and therefore we want to make sure that if there's topics or areas, the investor focus can happen, and as well we can certainly see if jurisdictions or organisations want to go further, then they can do that utilising the GRI standards.
Yeah, that makes sense. Marcus, did you want to comment on how this fits into the EU's frameworks?
Yeah, exactly. So well, it'll be pretty quick, but I just want to say I think there's a lot of focus also both from the European Commission and from the bodies you represent on making sure that these reporting standards are at least not inconsistent with the EU regulation. Then the EU might require its companies to go further in certain ways, double materiality, but that, you know, once the European companies have reported, then they would also have reported in compliance with your recommendations. And when I could also, when I'm talking about the European regulations, there I'm specifically thinking about the Sustainable Finance Disclosure Regulation, so the SFDR, and then the Corporate Sustainability Reporting Directive, the CSRD.
Great, thanks.
So Taylor, and I'm conscious of time, so I'll keep this very, very brief, but I can certainly confirm the sentiments that Marcus has expressed here. I just say that the work is still ongoing with the Commission, and we're really, both the Commission, EFRAG and ourselves, are very focused on maximising the interoperability between the two reporting regimes.
So it sounds like there's a lot of work being done to make sure that in jurisdictions that want to go beyond what's being discussed at the global level, they have the space to do that, and it will be interoperable with global standards. Makes sense. Any questions from the audience? Yes. Can I have a mic for the woman in the third row? Thank you.
Hello, my name is Guyana from Sustainalytics. I'm the biodiversity expert. Talking about disclosure, just focusing on carbon, we're blindsided to the wider nature-related risks. The EU is taking big steps towards this. The ISSB in COP15 hinted, or they announced that they would look into incorporating nature-related disclosure. Can you give us any time horizons on that?
Sure can. And there was that reference that you made at COP, but also the December board meeting of the ISSB also gave a little bit further granularity around that. And I'll just be, to give some context, as S1 and S2 are being finalised in order for publication, the ISSB then undertakes what's known as an agenda consultation for their work program for the next 2 years. That will be launched, I think, either late April or early May, with probably a 120-day consultation period. And in there, because we've already heard quite a lot of the passion and the importance around nature, that I suspect much more will come through with that process, and we'll then be able to transparently give you a sense of exactly the priority and the timing of responding to that priority.
Maybe, sorry, one comment. I think the work, and keep me honest here, obviously, but the work of the TNFD is also quite paramount in that regard, right? When I would think about just from an investor perspective, how long it takes at time for those kind of elements that are on an intellectual level make a lot of sense to make it down to investment decision making, that takes a minute. Like when you think about TCFD, when was it, like 2017 if I'm not mistaken, and then things happened. The UK as the first made it mandatory, and was just like clearly like really running front there, which is amazing. And then when you consider that TNFD is just like in the midst of works, right? There needs to be, and that's not discounting by any means or in any shape or form the importance of this whatsoever. But when it comes to base something on base financial decision making on data, that's different from looking into it, it's different from analyzing, it's different from getting informed. But having like hard-coded financial decision making based on data, this data needs to have like a certain form of robustness, which again, if it was up to me personally, that should all be in place already. But there is something, again, and I'm speaking again as a fiduciary money manager, that we need to also check around information quality at the end of the day.
Yeah, we have another audience question.
May I say, before the gentleman asks question, so just when it comes to nature-related risks, it's even more important to focus on materiality, because this nature-related losses are so much more multidimensional than climate change. So, I mean, if we have difficulties focusing on materiality when we are talking about climate change, then I'd read what's installed for us.
Thanks. Yeah.
Hi. Sorry. Etienne. I'm with Impact Finance, lead the public policy. My question is for Sasha, but also Carlo. We've seen, we've seen SFDR rolling out in the EU. The FCA just published, like a couple of months ago, its proposal for an SDR, whereas the US also, the SEC published a similar proposal. How are you learning from the bumps that the EU experienced with the rollout of SFDR?
First one's for you.
I think the first one is for me. Yeah, hi. Well, like anything in life, if you don't go first, you can learn from others. Good experiences and bumps. I like that word, bumps. And some of the things that we've learned from that has been that, one, it was a disclosure regime and ended up being used a lot of the time as a labelling regime, and you know from Article 6, 8 and 9. So I won't go into too much detail, but that. And of course, when you use numbers like 6, 8 and 9, what do you think commercial product marketing people, they all want a 9 and not a 6 because it's a higher number. So you get hierarchy. So we've tried very hard not to have hierarchy, because if you're a consumer, and that's how we think of the consumer all the time, they might not want a very niche product or a 30 stock portfolio for their pension. That's not very good for the capital allocation, but they might want to take sustainability considerations into it. So we've got focus, improve and impact, and it's okay. Secondly, back to your point, a lot of people got more excited about exclusions and excluding things, which of course are an important part of it, but are not everything, because if we're trying to change the things that we've just been discussing, and you talked about with nature and everything else in the other panel, you can't just avoid huge swathes of industry. You have to get them to do things and push them and be active stewards and all of the things that we talk and influence. So our big label, which is different, is the improve label. And again, when we first started it, we used the word transition, but we did a survey, or some surveys with over 15,000 consumers. Transition to what? They don't understand it. But improve, oh, I know how to improve. I want improvement. I want that. So we've been learning and using consumer language so that people can understand that. And also it's because we shouldn't exclude a lot of the time. We should be influencing, especially if you want to change. You need oil and gas to change. You can't just exclude them and hope that they change. So those are three of the things that we've learned from that. And then last but not least, it's not just about, it's the naming. It's the names that are allowed to be used. And some of the names are, you know, in terms of responsible, sustainable, and how you use that. And that's what's happening across the world. People are looking at the naming. So hopefully that's helpful. Carlo.
Yeah, I'll chime in. So first of all, it's interesting to, when you think about SFDR, it was never clearly being intended, as Sasha stated, as a labeling regime. The thing is, even ESMA publicly stated, I think last year around February, March, that SFDR is incorrectly utilized as a quasi-labeling regime. But the way financial markets work, it's not that anybody reads this and say, okay, that's not the intention, and now we're going to like change overnight. It's still being used incorrectly to get like at times on buy lists and things like this. It's the reality. The only thing is what has happened, that this Article 9 category, because of additional language being, additional answers being given by the EU, which means, and I can quote this, they said, well, an Article 9 product should be exclusively invested in sustainable investments and should only hold non-sustainable investments for either liquidity or hedging purposes. That's the exact wording of them. Well, that automatically rules out a lot of broad diversified portfolios, including climate benchmark, EU Paris-aligned climate benchmarks, if you ask me, by the way, which makes it a de facto, for a lot of things, null category, unless, to Sasha's point, you are really going in really fundamental, concentrated, illiquid, or you focus on green bonds. And that's clearly not in the interest of consumers. So the point is, and clearly there's a second mover advantage in that regard of the FCA to learn from this, and they did. And also, what was nice during the consultation process, I have to say that the FCA, they were listening to feedback, because that has not happened too much in my so far experienced that there would be a proposal coming out from a regulator, and then of course there would be like smaller tweaks, and then you have like splitting hairs. But there have been, the feedback was taken in, there have been quite some fundamental changes along the line. So that was good to see.
Great. Sasha, did you want to comment on that at all?
I mean, I've come from industry, and that's why I came to join the regulator from 25 years of running money and stuff. I think it's really important to listen to the industry. And that's why we had a disclosure group that was made up of 17 people who are selling products in the market and understanding what it's like. And then the last point, we are a consumer regulator. So we have gone out and surveyed consumers to understand the word. They don't understand the word stewardship. And yet we spend all our time talking about stewardship. And it's a great word, and it's a really important thing to do. But explain it to the consumer in the language that they understand. And so we've just said that we want a two-page document, because the one thing we hear all the time, I've bought this green fund and it's got oil and gas in it. I don't understand. And it might be for the right reasons, that oil and gas company is changing, it's got a plan, it's moving, it's doing that. But explain that to the people who are buying your product, and that's what we're trying to help.
Great, thanks. I'd have a follow-up question for Carlo. You spoke about some of the climate-related benchmarks. From an investor perspective, what is your experience with the adoption of some of these frameworks across jurisdictions? How similar are they, and how is that affecting your decision-making as an investor?
The reality of things is that those benchmarks are actually, from a technical perspective, quite different, right? At the outset, it looks like a perfect storm, right? Especially for investment professionals or houses that are reliant on scale products, right? So you have a European Commission that puts together a technical expert group that comes out with a blueprint and how you should construct a portfolio, right? It's just like, it's kind of the perfect storm at the end of the day. You would assume, okay, that's amazing. There's an official institution that tells me how to construct a portfolio, and everybody should follow this. The reality of things, though, is that once you then start to go into the weeds of the possibilities on how you can construct those portfolios, which kind of data sources you use, which kind of metrics you use, that can be quite dramatically different, right? And those kind of metrics are ultimately then informing capital allocation decisions, which is also an important point to make when it comes to understanding the difference between general KPIs when it comes to disclosure is not going to be the same as what different data vendors would do with this data to come up with their own metrics, because we must not forget that they are in competition as well, right, to come up with the next great way of, or next data point that can be utilized in portfolio construction. So what that means from a fundamental perspective, they are trying to do the same thing, but the way they will be constructed, if you would like look under the hood of an MSCI Paris-aligned benchmark versus a S&P based or stocks based or whatever other benchmark provider might have, you will see different metrics that utilize different methodologies are being used, and the way the actual underlyings are reweighted is different. And there's nothing wrong with this, because just it's good for innovation. Nobody is, in my view, complaining about the fact that different big asset managers are constructing portfolios in different ways. Even within the same kind of thematic bucket, there would be like, if that was the case, I would probably wanna write an article on bubble risk, right? So at the end of the day, it's totally okay, it's good for innovation, but it needs to be acknowledged that they are different, which means the due diligence process for an investor, even for the sophisticated ones, when choosing one of those propositions, needs to be as thorough as in any other circumstance.
Great, thanks. I want to bring it back a little bit to reporting and disclosure standards. I guess this question would be for Lee and Sasha. What can be done to ensure that some of these standards are truly global and not just being taken up by European or North American jurisdictions? Lee.
Yep, thank you, Taylor. If I sort of reshape your question slightly, I think it's trying to draw the distinction out that we just don't write standards that are for the advanced economies. And that message has come through very, very strongly in the consultations we did, particularly from G20, but from a number of other groups, the Financial Stability Board and so forth. So if we take climate as an issue, not the only issue, but as an issue that we're dealing with first, we need a global response to a global issue. So therefore, we need to shape, and this is our challenge, we need to shape standards that allow all to use as a global baseline. And how we do that is that we try and make sure we build in enough guidance, enough options to allow those that may be building up their expertise and capacity at a jurisdictional level to still feel that they are able to join in responding. And that's the philosophy of what the board's been doing, that I will continue to be focused on making sure these standards are fit for purpose for around the globe and build in as much options, scalability, proportionality to the requirements of the standards.
Thanks. Yeah.
There's a question there.
Sorry.
Should we do that before Yeah.
Sure.
I didn't have much to say, it's fine.
Yes.
Thank you. It's Anushka Barber from FTSE Russell. And actually I had a question on SDR, so sorry if I'm interrupting the flow on the global disclosure question. So it was just really just to say that I think we really welcome the FCA's very pragmatic approach to SDR, as you say, learning from the bumps on the road, I think someone mentioned in terms of other disclosure regimes. And also very reassured by, I think, Sasha, your comments just now around making sure that retail investors, the only funds that deserve an ESG or a sustainable label are those that are very dark green and very concentrated. But just in terms of practically, we've been looking at the 3 labels, and we are struggling to see how a broad, diversified, sustainable portfolio might meet, for example, the year-on-year improvements that are required in the improvers label, and for the focus label, kind of, just really interested in your views, kind of how do we make sure that those kind of very diversified offerings can meet, the 3 labels that the FCA have done so much research and testing on. So just welcome views from Sasha and
well, I'll go first, and if anyone else wants to. The first thing is we put out a consultation. So we've done all the work and still listened to everyone. Thank you, Carlo. And then still put a consultation. I've had 240 responses. So we are going through that because some people have come up with some very good points that could make it even better. And some of that is the points that you've made on how do we measure this. Now, part of that, as we've said, is let's get the first set of ISSB standards, and then we have better metrics to be able for people to be able to measure things and be consistent. But we're absolutely working on that at the moment. And going through those responses, there's quite a few buckets that are coming through that are similar in saying this is quite difficult and this is quite easy. But we're making sure that to begin with, we've said that it's up to the asset manager or the product specialist to put their own KPIs in. We're not telling you which ones. It's not. We should not be prescriptive. So we've been very careful on that, and we want to make sure that. So if you want to say a green income fund, then it's your job to say why it's green. Not for our job to say that it has to be this way on a specific taxonomy, otherwise you're not green, because that's not fair to start with. And then secondly, I think it's really important that we're looking at other things to help, including ESG ratings and things in terms of how that is measured. It's not just about one thing on labelling, and it's all the other work that's going on. They're in parallel, but this is in place. But we're not asking too much, I think, in the beginning, but we'll wait till we get all that feedback, and then we'll even adjust it even more.
Great. We have another question from the audience here in the front row.
And while we go to the question, what's going to be interesting, and especially in the context to your question from FTSE Russell, right, with diversified portfolios, is around with all the best intentions, then finding the proof in the pudding, especially for things that you might not be able to control, and still find, and where this meets in the middle, right? That's exactly what I think a lot of the feedback was about. Certainly the ones that we gave, but that's being worked through, and it's non-trivial, right? But the important thing is, for now, that I feel that there's a dialogue going on, that that's not like just rejected as irrelevant, right? So.
Great, thanks.
Yeah, Sheila Bijiwe, Central Bank of Kenya, Deputy Governor. It's just on the standards. I sit on the Financial Stability Board for Africa, and I'm not really clear that we're really heard. So I think as we go forward, more attention needs to be given to those issues to make sure that when the standards come out, the views of all have been heard. And I think that also where Africa is on the green agenda is much more ahead than people know. So I think that more thought needs to be given to this issue as we move forward. Thank you.
Great, thanks very much for that.
Can I just say a
Yeah,
quick response
please.
on that? So thank you very much. I think we will always make sure that we're listening to as many as we can, but we were quite heartened when Nigeria at COP27 came out and said they will be one of the first runners through of S1 and S2. But we've got much more work to do in Africa, there's no question about it, and we announced at COP as well quite a significant program of capacity building, which I think we can utilise then also as we continue to shape standards further once we have our networks and programs of work in place.
Great, thank you. I guess I would like to shift the discussion a bit, just given the time. I'll come to Marcus now. So as we've discussed in a few previous sessions, there's differing views on how central banks should be approaching the sustainable transition. I have a two-part question, I guess. So from your perspective, what role should central banks play? More of a lead by example or more of a standard setter, more actively? And the second question is, of the progress made by the subgroup on climate-related financial disclosures of the NGFS, what excites you the most happening there? Thank you.
Okay, thanks. So first of all, yeah, central banks should lead by example, but they should also do much more. And now I guess we're just talking about disclosures, not more broadly about how they are approaching climate change and sustainability. But I mean, another reason why central banks disclose, that's simply to answer to answer calls from the public about ensuring transparency about the central bank's activities, the functions, their relationships with the financial sector. Then disclosure also forces the central bank to into some discipline about learning about the different metrics and targets that are being used, and this could eventually help the central banks in fulfilling their financial stability mandates, because they're better able to assess the metrics being disclosed and different metrics. And then finally, I think central banks, and perhaps that's the, or I would actually think that this might be the most important contribution of central banks when disclosing. That is that central banks are, validating or vetting the different metrics and disclosure standards and so on from an impartial perspective. So many of the partners, people who engage in this debate, have an incentive one way or another way. It could be an asset manager that has to maximize the client's profits. It could be a green NGO that wants to do certain things for the climate. It could be other people. While central banks are a bit more neutral on this playing field here. They're like the referee. So that would be my answer to your first question. Then you also asked me what excites me the most about the subgroup within the NGFS that I'm chairing together with Liliana Geronimo from the Portuguese Central Bank. And well, first I would have to say the breadth of the people who are involved. So we have 64 participants from 35 institutions, and these institutions cover the Southeast Asia, the Oceania, Africa, Europe, and both North and South America. So I think that's really great, and I think that's good in terms of ensuring that we have global disclosures, that there's interest about this globally. And then one other thing that I really like about this disclosure work here is that it really allows us to think holistically about how climate change impacts the economy. So central banks with the price stability mandate and the financial stability mandate, then essentially they have a role in ensuring a robust economy, broadly speaking. And the way that climate change will impact the central banks, that then matters for this goal. And so if central banks want to disclose holistically about the climate, then they need to sit down and think broadly about how the climate impacts the economy, and that has to be fit in a way that works into these disclosures. So it sort of it allows for broad thinking and taking an eagle's view of climate and the economy.
Great, thanks, Marcus. Are there any other audience questions? Otherwise, as we are coming to the end of the session, I think that I will just pose all of you the question. I think it was put quite nicely by Judson in the last session from the TNFD, that they are trying to take the climate playbook and use it in some senses for nature. I wonder, do you think that this is possible and desirable on social and governance considerations, going beyond the E in ESG, as the cliche phrase goes? How can we use the work that's been done on reporting, building transparency, mitigating risk, disclosures, quantifying all of these different metrics? How can we apply that to social and governance considerations? I'll start maybe with Sasha.
I shouldn't have sat next to you, should I? Yeah,
A hot seat.
But the word ESG has S and G in it, so let's not forget that. I mean, it's been there for a long time. So, and G, I mean, I'm a regulator. Do you think the most important things that we care about are the governance, accountability, the senior managers regime? How do you incentivize people? These things are already there. So this isn't all new stuff at all. So I think we've got to make sure that we remember that. Of course, some of the areas of S are probably the areas that we've probably got the newer areas, but it's not that new. And people are talking very much, and we've seen what's been happening with payments, supplier payments, health and safety, a lot of the diversity work and socioeconomic. So this is coming, and all we're after really is it's got to be important. And the people who are pushing it the most are the employees of the companies that work for. So let's remember that. When I speak to the chairman of companies, they are getting really big push about, I want to work for a company that I believe in. So the retention and training of engineers of an oil and gas company, they're not going to work for them if they don't believe that they've got a plan on this. So this stuff is coming, and of course it's been selling, and that's why we've had the products, and that's why we need to bring labelling. So I'm quite confident that this is just an evolution.
Great. Lee, do you have comments?
Thanks, Taylor, and just picking up on what Sasha then just said, I think it is a bit of an evolution. I think from a standard setting perspective, it's very clear that there is already demands in different ways to move outside of the E and to explore the S and the G. I think when it comes to the S, I've recently returned from Japan. There was a very strong sentiment about human capital being expressed there, and Sasha touched on this a little earlier as well. I think the only element I'd share is to say what we've done with S1 and S2, particularly S2 on climate, is not necessarily the blueprint of what we will do next. So, we need to think through what is the best approach, and we've got some fantastic intellectual capital that we acquired through the consolidation, both from integrated reporting and from the SASB in terms of all their great industry-specific disclosures as well. So I'd just say watch this space, but it will certainly be broader than E.
Great.
Yeah, I'm happy to. I'll make it short. I know we think we're almost out of time, but I think that it's clearly established that social elements are financially material, and obviously you could argue at some point that a lot of those elements that are, once you would establish that they are financially material, that they're actually part of good governance in the first place. Yeah. So, I mean, let's see where that goes. The only thing is where it's arguably going to be a little bit different, and I don't have a perfect answer, but in the social aspect is that you think about transition and physical risks. Like, think as an insurer, right? It's like a very scientific, more of a fact-based approach. Arguably, what's happening with the TNFD is going like quite into this direction from a process perspective. So you would ask a scientist in one area of the world about physical risk, and the scientists of the same profession in another part of the world, they'll probably give you the same answer. When it comes to social aspects, like the way cultures are built and the way societies are built, there could be a little bit of a difference, I guess, from region to region, which does not by any means that it's insignificant. It's very, very significant. So that's where I feel down the line it might be a little bit more tricky, which doesn't mean that it shouldn't be done, but that's a little bit my comment.
We need a whole extra hour to discuss all of the implications of that, but for now I'll just let Marcus, any final thoughts on this last question?
I mean, so I'll really perhaps just end where I started, so to say that, I mean, the key governance, hugely important. None of this is going to matter if you have a bad corporate culture.
Great. Short and sweet. Well, I think that concludes our panel. Thank you so much. And we are now going to a drink break. Yes? Okay. 15 minutes. And then we'll continue with the session moderated by Clive after this. Thank you.